For our depreciation waterfall, before beginning, let's just finish off our formulas for ending period balances just for efficiency, because we're going to split up these line items, and once you split them, it's very hard to make your formula efficiently. So let's start from the end of period property, plant and equipment balance. We're going to start from beginning balance added by the substitution added by capital expenditures minus depreciation. And because now we have, because now all the line items are right next to each other, we can just simply push it to the right, push it to the bottom, and we have our formulas ready. So back to depreciation. First of all, for land and construction in progress, as I mentioned before, these two line items, we don't do depreciation. So these two line items are going to be, all marked to 0. So let's finish these first. Let's just copy and paste the existing formula, existing cells, paste and paste. Okay, and then for buildings, machinery, and furniture, we're going to make a depreciation waterfall. First of all, let's add a useful life assumption right around here. So let's copy and paste. Copy and paste one of these formulas, Alt EST, and we have our useful life assumptions in our PPE raw data. Of course, land and construction in progress, no useful life. Buildings, machinery, furniture, 40 years, 5 years, and 5 years. So useful life information. Actually, it would be a better idea to link to our useful life assumptions. So buildings, machinery, furniture, 40 and 5 and 5. Let's do a little bit of formatting and let's go to customs, Control 1, format cells. We're gonna select custom. We're gonna do a little bit of formatting. Let's just add a years symbol at the end. So it's going to be depreciated for 40 years, for 5 years, and 5 years. So that's the useful life. And then let's add, Control R. I've added five additional rows, and we're going to split depreciation into 5 components. What we're going to do is we're going to forecast depreciation for existing PPE. So this line would be for depreciation for the beginning of period balance that has already been existing for 2024. And then we're gonna separately forecast depreciation amounts for 2024 estimate capital expenditures. So separately, capital expenditures for 2025, capital expenditures separately, as well as 2026 and 2027. Let's just indent these line items. So what we're going to do is, calculate depreciation for the assets that has been already been there. But for additional capital expenditures, we're gonna calculate depreciation separately. We're gonna simply divide the capital expenditure amounts of that year to the useful life. So we're assuming a straight line depreciation method, and we're assuming that there is no salvage value. Just simply, after fully depreciated, the value of the assets would be 0. So how we're going to do that? For simplicity, let's start from existing PPE. So existing PPE, how it's going to work is we're going to simply divide beginning period amounts. So beginning amounts at year 2024 for buildings. So a $25.7 million. We're going to press F4, and this is going to be divided by 40 years. So spread it out evenly for 40 years. So an amount worth $0.6 million would be depreciated for the existing PPE. However, for 2025, not only this amount is going to be depreciated, but also the additional capital expenditure from 2024 would be added to the depreciation total amount. So what we're going to do is, it's not only the capital expenditures, but also for buildings we had amounts coming in from the substitution tab. So we're also going to include that. So the formula would be building substitution amounts, so 0.9 million, again F4, plus capital expenditures. Of course, the numbers are 0, but also an F4. So a total of 0.9 million that has been invested in 2024 would be divided by 40 years, again F4, and be distributed evenly throughout 40 years. So this amount would be depreciated each year. Of course, it looks like 0, but if you add the decimal points, 0.02 will be depreciated. Same goes for 2025. So 2026, we're going to add 2025 capital expenditures. So others in 2025, F4 plus buildings F4 divided by 40 years, F4. Similar in 2026, 2027, we're going to add 2026 buildings F4 plus capital expenditures F4 divided by useful life. And then lastly, a similar process. Buildings divided by useful life. And we're going to simply sum these 5 lines here. And we have forecasted depreciation for building asset classes. So yeah, maybe you can agree or maybe you'll not, but somehow people think that this looks like a waterfall. Does it look like a waterfall? Yeah, I do agree to some extent, but anyways, it's called a depreciation waterfall since it looks like this. So we're gonna do some similar. We're gonna apply similar mechanics to machinery and furnitures as well. So let's simply copy these line items. Add it in between. And let's just erase the existing data. Probably a quicker way to do this is for existing PP, we're going to do pretty much the same. So for existing PPE, we've just simply divided the beginning balance to useful life. So we're going to do the same for existing PPE. Machinery and equipment beginning balance, F4 divided by useful life, F4. But here, since the formula is a little bit complicated and we want to be a little bit more efficient, let's first make one formula. So 2025 depreciation would be from 2024 others, F4, plus 2024 capital expenditures, F4. Actually, let's redo the anchoring process. Let's leave it alone. And then divide it by useful life. And for this, we're going to anchor it. And let's simply push it to the right. And what it does is now we have calculated our depreciation amounts for 2025 capex, for 2026 capex, and for 2027. We need these formulas the next year, the next year, and the year after. So I just simply pressed Control X. We just cut the formula, paste below, cut the formula, paste below. Again, the same process, and we can simply make, our formulas follow the numbers from the past year. I guess this is much more efficient and simple than what we did up here. And we can use a sum formula to add up all the depreciation amounts. And we have our numbers for machinery and equipment. Yep, let's do a similar process for furnitures as well. So we're beginning from the beginning balance, furniture, fixtures, and others, F4 divided by useful life, F4. We're going to make depreciation assumptions for 2024 capital expenditures. So add, where is it? So despite the fact that it's 0 for consistency, we're gonna include it, and capital expenditures divided by the useful life, F4. We're gonna shift it to the right, Control X, and lastly Control X. And lastly, the summation process. So we've finished our forecast for all 5 classes of asset items. So simply the total depreciation would be now simple to calculate. We can just simply add all 5 line items: land, buildings, machinery, furniture, and construction in progress. Add it all up. At this point, some of you might be wondering, well, for land, it doesn't have that specific issue, but some of you might be wondering for machinery and furnitures, because their useful life is only 5 years, some of you might be wondering, should this amount, so should the depreciation amount from existing PPE, should this be, slowly declining? Some of you might be thinking that. And yes, I also think that the numbers should be slowly declining, because in 2024, if the useful life is 5 years, this number makes sense. But in 2025, some of the depreciation, some of the assets that has been purchased in 2019, for instance, would have fully depreciated, should have fully depreciated, and thus the amounts of depreciation should be excluded. And then the year after, in 2026, assets that were purchased in 2019 and 2020 should not be depreciated. So these amounts should be slowly declining according to our useful life estimates of 5 years. So how are we gonna reflect that in our existing model? That's the issue. So let's also reflect that into our working model. What we're going to do here is we're simply going to make let's highlight these first. So 2024 capital expenditures, we don't have to change anything, and for buildings we don't have to change anything, but for machinery, so let's highlight these cells just to avoid confusion. So we're going to change our formula for these 4 cells. We're going to do a simple adjustment of the formula. We're going to add to the bottom of your spreadsheet, we're going to add a simple 1. We're going to add a simple 1, 2, 3, 4. We're going to color code this into a dim gray color, just to show that this is irrelevant to the actual model. And how we're going to do is, in 2025, 1/5 of the total depreciation amount from the year before should be excluded. So, and in 2026, it's going to be 2/5, 3/5, and 4/5 is going to be excluded from the total depreciation amount. So we're going to fix, what we're going to do, we're going to subtract this, we're going to subtract this amount, F4, times 1 divided by 5 years, F4. So eventually this is, so eventually this represents 1/5 of the total depreciation amount, which we're going to exclude from the total amount. Let's shift it to the right. And we can see that, slowly existing PPE depreciation amounts decline. Let's do a similar job here as well. Minus previous year's total depreciation, F4, times 1 divided by useful life of 5 years, F4. And we're going to make it slowly decline. And eventually in 2029, since the useful life is 5 years, if we had 2029, it would be now existing PPE as of 2024 would be fully depreciated, and now it would, equal 0. So we've also finished our depreciation waterfall, and now we have all of our line items ready to go and connected to our existing working model.